Bob, thank you very much. Getting to our closing bell exchange now for this Thursday. Tom Lydon from ETFtrends.com is with us today. New York Stock Exchange trader Jonathan Corpina from Meridian Equity Partners sitting right next to me here at Post 9. And Rick Santelli checks in from Chicago. So, John, you got the post-Fed hangover today. You've got oil testing Monday's lows, and you've got an expiration tomorrow. So, is that the reason we're off today, or what do you see happening here?
I do, and I think today is somewhat of a pause, right? We've been waiting for this date of Wednesday, yesterday, has been on our calendar. It finally got here. We got what we were expected, and there was a lot of excitement leading up to that, and trading activity leading into that. Today's a big pause. Tomorrow we've got a big expiration. Quadruple witch, S&P rebalance, Russell rebalance. So tomorrow gives a lot of people opportunities to really make their final moves of the year. Next week, short week. The following week, a short week. So tomorrow is really that last chance to step in or out of this market. So why make a move today? I'm not so dissatisfied with this sell-off that we're having today. Market's up close to 2% for the week. So why not have this little sell-off today?
I wonder, Tom, whether stocks, though, as we look into next year, will ultimately benefit if people are pulling money out of bond funds. Do you expect them to do so? Think they should do so?
Well, obviously, they've been in the fire, and that's been the big key. However, there's market risk, but there's also interest rate risk, Kelly, and there are a lot of people that are looking for yield, especially as we go into a rising rate environment. So there have been some creative ETF issuers out there. They've done a great job of reducing rate risk. For example, Wisdom Tree, ProShares, where you actually have the market exposure, but virtually zero duration. So you've actually got the exposure, and maybe with valuations the way they are today, and as Bob was saying in the earlier segment, if oil bottoms out at these levels, especially in the high yield market, we might see some opportunities to the upside and some pretty attractive yields.
Rick, in your view, are the markets turning their attention away from the Fed now that we've got the rate hike out of the way, at least for the time being? Are we looking at oil? What else do you think the market's thinking about right now?
Oh, I'm going the other way. I think that up $1 or a penny and a half on the dollar index is pretty much all based on what the Fed did yesterday. And
right.
You can, in some fashion, connect the dots to the dollar-dominated commodities, maybe change the demand story, or however you want to slice it. I know oil is the big story today, but how much of oil is affected by the dollar? I think these issues are big, and I continue to say, Mexico, not that it's the first, but they raised their rate 1/4 point at 2 o'clock Eastern. All these emerging markets, China's currency down the 10th day in a row against the dollar. So I think that all these moving parts, really the catalyst was the upcoming Fed rate hike. Now post-rate hike, it's how the digestion process is working. We talked yesterday that it might take a couple days to simmer. But the fact that the one sector that didn't need any simmer time at all was the dollar index. And I really do think in a world where any different economy like China with their currency move could try to tweak the game by beggaring thy neighbor on a weaker currency, the dynamic of the post-Fed dollar is what you're supposed to be paying very close attention to.
That's a great point, Jonathan. How much do you think stocks are moving in lockstep or moving in an opposite direction as the dollar moves higher, stocks move lower? Is that what you think is happening here? Do you expect it to continue?
I do. We're seeing the dollar up, oil down, and market down, and I think investors are trying to pull some correlation together in this new environment, this trading environment that we haven't seen before, experienced before, with interest rates the first move in a decade. I think investors are looking for anything to hang on this point. Some portfolios are flat down for the year. You do have a few trading sessions left to try to make some money back in this market. So if you do see a pattern here, I think investors are trying to really jump on board of that pattern.
Tom, are you changing anything about your portfolio mix with the Fed doing what it's doing? And let's face it, this deflationary trend that we've seen with a lot of the commodities as the dollar goes higher. What are you doing about it right now?
Well, absolutely. There's a lot of discussion about currency, and I think Rick was dead on right. We're going to have to see the euro see parity, and there are a lot of ETFs that hedge currency, and I think as we're getting to year end here, there's a lot of tax loss harvesting. We saw huge money go into some Goldman Sachs brand new ETFs that were coming out of some well-established emerging market ETFs. So tax loss harvesting, more strong dollar hedging that we'll see in 2016. And as I mentioned before, from a yield standpoint, there's some great opportunity at these levels if you've got a cast iron stomach.
Rick, before we have to go, let's just dwell on the dollar for one more moment, because we thought that for the most part, this was going to be a buy the rumor, sell the fact kind of move. It had moved up appreciably into the Fed hike. Why do you think it is still moving so appreciably today?
Because I think there's no way to evaluate what was priced in, and the axiom of, what's built in, buy the rumor, sell the fact. It all sounds cutesy, but that's not the world we're living in. This is the first time a major economy is really trying to come off zero. And I think how that pans out and the dedication the Fed has to buy some insurance to get rates up is going to be a dollar positive. And all the other axioms that work against that, to me, just don't make a difference.
All right, guys. Appreciate your thoughts on today's market action. Thanks.
Thank you.
See you around.